Hi, everyone. My name is Devina Khanna, and I am a policy manager at the Financial Health Network. Welcome to our webinar exploring the earned wage access and direct-to-consumer advanced space. The Financial Health Network has spent the last year on a research initiative to better understand this space and how consumers use these products. Last week, we published our report, which I encourage you to read and share. This research initiative was spurred by the emergence we've seen in the last few years of fintech companies that aim to provide consumers with early access to their wages and with additional liquidity. These products are typically targeted at hourly and low-wage workers who often live paycheck to paycheck. As many of you are aware, 1 in 5 consumers has less than 2 weeks of liquid savings. And the time delay between earning and accessing wages can lead to financial distress and drive consumers to seek out high-cost liquidity products. We've seen the earned wage access and direct-to-consumer advanced space emerge in response to that demand for liquidity. These products have also attracted attention from policymakers and consumer advocates who have asked questions about the merits and potential risks of this space, and most notably, whether these products should be subject to lending laws and regulations. The Financial Health Network has a number of these companies in our membership and in our lab. From a policy perspective, we are often asked for our view on this space. We believe that data is the first step in assessing any product and its impact on financial health. So we partnered with 4 companies to better understand how consumers use these products. These companies provided us with at least 1 year of usage data, and we are grateful for their collaboration. This report was made possible because of the contributions of Arjun Kaushal, Najati Chelik, Nadia Vandewali, Beth Brockland, David Silberman, Corey Stone, and Jennifer Tesher. We'll be diving into what we found from this data, but first, I want to introduce the experts who will be joining this discussion. Leslie Parrish is a senior analyst with IT Group's retail banking practice focused on consumer lending. Nikita Coutinho is a visiting assistant professor at Duke University School of Law, where she primarily researches financial innovation and inequality within the fields of consumer finance and corporate finance. I'd also like to note that Nikita just published a paper yesterday on this space, and I encourage all of you to take a look. And lastly, we have Swathi Karandikar, who is the Chief Compliance Officer at Even. Swathi brings a wealth of knowledge and experience with regulators, fintechs, and financial institutions in consumer finance. Now, we recognize that many of us have Zoom fatigue, and round-robin panels have become old and monotonous. To switch things up, we've sent each of our speakers colored paddles to answer questions. They are red, green, and yellow. We'll ask our speakers a series of questions and to hold up a paddle that corresponds to an answer. When we start to see different colors, we'll ask our speakers to expand. So I'd like to just start with an easy warm-up question, and thank you again to all of our panelists for joining. My first question is pancakes or waffles? If you prefer pancakes, hold up red. If you prefer waffles, hold up green. And if you're like, French toast, hold up yellow. All right, there we go. We've got some diversity there. Leslie, is it French toast or is it something completely different?
Absolutely French toast.
Good to know. All right, well, I'd like to first start with talking about the landscape of this space, because when this space first emerged, industry analysts categorized and assessed companies by their delivery channel, so that companies fell into one of 2 categories. And in a simplification, some companies partner with an employer or payroll provider and have access to wage or time and attendance data. These companies provide consumers with access to a portion of their wages and then recoup this advance from the customer's next paycheck. Other companies work directly with consumers and will connect to a consumer's bank account to monitor inflow and outflow patterns. The company then will provide a certain amount of liquidity when the consumer requests it and recoup the advance from the consumer's next bank account inflow. But in recent years, we've seen that this space has expanded as more providers have entered the market, and companies themselves have also evolved the products that they offer. So my first paddle question is pretty simple. Does this two bucket categorization work? Is it a two bucket for red? Is it all, just the same? We should look at all of these products similarly, and that would be green. Or is it none of them the above, and it's more difficult to categorize these products? Hold up yellow. All righty, so we're seeing a little bit of difference there. Leslie, I'd like to start with you. I'd love to hear what your thoughts on this space are.
Yeah, so I think that two bucket categorization is pretty useful. So I held up the red. I will caveat that there is a lot of nuance within those two product categories, but I think two categories is useful because those two categories vary in terms of the type of data the companies are seeing. Are they seeing actual payroll data, or are they estimating earnings because they're looking at bank account data? And also the recoupment is a little different, like you mentioned. But within those categories, there is a lot of nuance in terms of the that can be accessed, what the revenue model is, so what the fee is structured like, who's paying that fee, is it the employee, is it the employer, or a mix of both? Is the advance automatic? There are some direct-to-consumer models where there's an automatic deposit into your account to avoid an overdraft. In other cases, it's more proactive on the part of the consumer. And also whether there are kind of complementary savings or budget tools that really effectively help people move to a more kind of financially well state, becoming more financially stable. So, I think those two buckets are useful, but a lot of differences within those two buckets as well.
And you bring up an interesting point about the other types of products that are offered. And that's something that many of the companies that we worked with in our research initiative brought up, is that it's difficult to assess this product in isolation. And it's important to think about the other type of product, say a savings product or a financial wellness tool that is offered in conjunction with the product. Nikita, you held up yellow, so I'd love to hear your thoughts.
Yeah, I held up yellow in part for many of the reasons that Leslie just explained. And that I think the broad categories are useful, to add that I think the employer involvement adds a host of different questions and how consumers may receive the product, privacy concerns that may raise red flags or not, may assuage some issues that consumers may have if the employer is involved. And so those broad categories are important, but whether it's a fee or no fee, and I'm not talking tips, I'm talking whether it's fully paid for by the employer versus not paid for by the employer in any way, shape, or form, like that impacts the costs that consumers may face in repeatedly using this sort of product. And certainly even within the employer aspect, some of them are payroll deductions, some of them are not payroll deductions. So really their recoupment is its own category to assess consumer effects. And so for those reasons, I think that is more nuanced than not just looking at employer versus non-employer, is really important in breaking down categories.
Thanks, that's helpful. I think you also bring up a great point about where is the revenue coming from? Who bears the cost? Is it the consumer that bears the cost? Is it the employer? In some cases, we've seen products where neither the end consumer, nor the employer will bear the cost, but instead funds are delivered onto a debit card or a prepaid card, and the provider will instead monetize off of the interchange fee. So I think it's interesting to see the various ways in which these companies make money. So I'd like to dive into our first finding, which was around usage. And as we highlighted in the report, I think this is a really important finding. Usage data tells us that this product is not necessarily a one and done product. we found that the majority of users took advances in consecutive semi-monthly periods. And this could indicate that these products have become a staple in the financial lives of the consumers who use it. What could this level of usage tell us about the purposes for which consumers are using advances? Is demand simply a function of a timing delay? Is it that consumers simply don't have access to their wages when they need it? So is it that maybe a bill is due on the 15th and they don't get their paycheck until, say, the 17th, and that 2-day timing delay creates issues? Or does this speak to a larger liquidity issue? Is it that consumers' expenses exceed their income? So I'll start with a slightly simplified paddle question, which is timing delay, red, liquidity need, green, both or neither, yellow. All right, okay, we've got some differences there. I'd like to start with Leslie again on this one.
Yeah, I would say it could be both. We know from, for example, your research at Financial Health Network that there's, a lot of folks whose expenses routinely exceed their income. And so they may be using these products to kind of solve for that issue in a way that, they would otherwise potentially be using payday loans or incurring overdraft fees on their bank accounts. But like you said before, it could be just expense and income mismatch by a few days, or it could be the fact that they have a volatile income. So their income changes over time. And this is a way to smooth it out between pay periods where they're getting paid a little bit more, or a little bit less. I'm not sure we've really done enough research to unpack, which is more prevalent. The question I would ask is, and where I'm primarily concerned is, are consumers using this as a substitute for kind of for more expensive products like a payday loan or a car title loan or incurring overdraft fees, or are they layering these products on to those? And I think that raises very different policy questions. If they're substituting away and saving money, that seems a lot more favorable to me. But if we're just giving people more and more products to get further and further behind, that raises concerns.
Thanks, Leslie. You bring up a great point that I've had many discussions with folks about, is that are these products being layered on with one another? Unfortunately, with our research, we didn't have insight into cash flow data, but it is something that we hope in the future we can take a look at. I think that would be a fascinating insight is, do uses of overdraft, for example, decrease with use of this product, or are there other products that are being used in conjunction? Swathi, you held up yellow, I believe, so I'd love to hear your perspective.
I held up red because I wanted some contrast, but I agree with both Nikita and Leslie. The likely answer is yellow, but we study and survey the usage of our EWA product, and we really want to continue asking that question of why people are using this product and how they're really using it. I would love to partner with anyone on that research. But so far in the surveys they're providing and responding back, overwhelming majority, over 70% of surveyed users communicate that they leverage our EWA product to pay their bills and cover their needs. And that response, that self-communicated response of survey is kind of backed in the data from FHN report, right? Where the average amount range was between $78 to $168. So these are really not expensive extension of liquidity use, or like larger exposure of liquidity use if we're really thinking people are living beyond their means. So I kind of wanted to compare both of those notes. And with that, I'm more on the bucket of timing delay, again, because we're also an employer integrated product. We're really providing the service to our consumers, to our employees, to mismatch the timing alignment here. So with that, I really think the likely answer is timing delay, but the outcome, consumers could be using it for both purposes. But I wanted to kind of piggyback on what you were saying, Davina and Leslie, with respect to the real question of whether this is a good use of funds or not. And we've spent a lot of time at Even thinking about this. And our policy proposition here with respect to that question, which is providing funds to the employees or consumers when they really need them, and then really capping those amounts so we cap it to 50% of their earned but unpaid net wages. So they have access to their earned wages, but they're not engaging in this like negative cycle if that's what we as policymakers are worried about, right? So I think there's ways to kind of guardrail that underlying question you raised, but still giving consumers, the options and benefits and opportunities here. So that's how we're thinking about it at Even.
Great, thank you. For folks that are watching, please continue to post your questions in the chat. We are seeing them and we will attempt to address them as we can. So please continue to send them. We'd also love to know your thoughts. You know, do you think that this is timing? Do you think this is a broader liquidity issue? Is it not as complicated? And if you have suggestions as to where we can find this information, please drop that in the chat as well. So I'd like to move on to another topic that has been pretty hot, which is recoupment. Advocates in particular have brought up concerns about some of the recoupment practices and if they could potentially be problematic. I do want to note that while we were doing this research, every company did indicate to us that consumers do have the option to revoke, pause, delay, reschedule payments. So it is completely something that consumers have the ability to do. We found in our report that 97% of advances are successfully recouped. So I'd like to talk a little bit about that. I don't have a paddle question, but I do want to start with Nikita because Nikita, this is an issue that you've brought up quite a bit, and I'd love for you to share your thoughts.
Yeah, so this actually sort of ties into the usage question for me as well, because if they're using it for like everyday expenses, these aren't emergency costs or some last minute expense that comes up. So what you have is a consumer who has a cash flow or liquidity issue, who uses this product, who either it comes out of their paychecks or automatically debited from their bank account, but we know that there's 90% recovery on this product. We don't know what an impact it has on their other bills, on their other expenses. And that might actually contribute to the fact that they're reusing the product again to sort of catch themselves up. And so the recoupment raises concerns for me, especially in the context of a service that is paid for by the consumer, because if they're recovering at a 97% rate, and then consumers are repeatedly using this product, and if we find in the data, which I hope to see, that they are either defaulting or having overdraft charges, which anecdotally that has come up with a number of consumers who reported online, that they have these other expenses come out, they can't cover them, they have overdraft charges, so they have a snowballing effect of costs. And so that's my main concern with the recoupment, and that even comes up in the salary links where it's coming out of a payroll. So you have a payroll deduction, your paycheck is short, and if you have expenses or bills that weren't accounted for either by you or the provider in advancing you the 50% or more in some cases, then really you have not only a timing mismatch, you have a cash mismatch, and that can create other problems. So.
Great. Thanks, Nikita. Swathi, I'm curious to know your thoughts on this one.
I definitely support the research question to consider here and really understanding the usage and the impact on consumers. To kind of tie the link you were making, Nikita, and the question I saw, I think the cap can help with the income smoothing, right? So to address the recurring behavior, and if it's a negative recurring behavior, the caps can actually address the income smoothing concern in that context. It could potentially have a negative impact. It's hard for me to perceive that, but I'm happy to research and partner with people on that for that matter. Separately, I think almost all service providers in this context are providing recoupment options. So if you're someone who's scheduled to have payroll deduction in place or ACH debit in place, they're providing revocation requirements, right? So similar to Reg E or Save H&R laws that allow you to provide as a right to the consumer that you could stop that payment. So I encourage as policymakers for us to kind of align similar practices that we already extend to different products and financial services in similar way, and also extend that same policy matter here too. So apply the same set of requirements and amplify consumer rights. So consumers can actually apply their right more widely. So from a recoupment perspective, I would specifically focusing on recoupment, I would focus on revocation rights. And to your larger question, I think the way we've thought about it is really around caps.
So we actually did get this question in the chat, and I want to dive actually, Swati, a little bit more into this, because at the Financial Health Network, we often get questions of like, should our role be to provide best practices for providers? And could one of those best practices be guardrails such as a cap, so a 50% of a paycheck? What are your thoughts there? Is the 50% driven by something in particular? And what are your thoughts on guardrails?
Yeah, so our personal opinion at Even is really, and the question was really good, right? If they're truly their wages, why can't they access all of their wages? And that's a question that comes up all the time. But the counter concern is that they might be engaging in somewhat of a recurring negative behavior. So our proposal here has been to come up with a cap of 50%. So they can access up to 50% of their earned but unpaid wages. And then on payday, there's still 50% that comes into your bank account to smooth out your income consumption, right? So what we're looking for is healthy, safer practices in this space. And that's been our proposal thus far. And so far, we're seeing positive responses here.
Great, that's helpful. We're getting more questions about this in the chat, particularly around these questions of access to pay. You know, should people just have access to all of their pay, and should they have to pay for it if it's their earned wages? And does this just speak to a larger policy question about minimum wage? If this is truly a timing delay, or if this is not a timing delay issue, and if it's a larger liquidity issue, should policymakers be taking a step back and thinking about the larger issue? I'll open it up if anyone wants to comment, but I think that's an interesting point that was made in the chat.
Yeah, I'll just briefly comment, because that's I often have a passive aggressive way of getting to that point when I'm addressing these products, because I do believe that part of the demand for this product, historically the demand for payday loans, we go back to salary loans, like part of the demand, or a large part of the demand, I think, is the fact that people aren't making enough. And so there is confusion and overlap of a timing issue, which may account for some of the consumers, and insufficiency issue, which I think accounts for a large part of even the payday market. And for me, the fact that people repeatedly use a product is at least a signal that there may be an insufficiency issue at play here. But on the flip side, when I think about it, sometimes I think that, like, hey, if you make people's wages accessible daily, you just disentangle the confusion between timing and sufficiency. If I can have access to my wages daily at no cost, I think that's really important. Then we resolve the charade or the timing question, and then we get to the heart of the problem. I think that is the inadequacy of wages. But so long as we have pay periods and we have products that claim to offer immediate access to wages and resolve timing issues, like so long as that is on the table, we won't get to the wage question, because you'll forever have the credit solution or quasi-credit solution or these sort of products. Another thing that I think about, though, like, yeah, why aren't employers, the idea that it's covered, the cost is covered by employers, I think they should absorb that cost. And by having them absorb that cost and have it tie into either wages and other employee benefits, also has the protection, I think, of labor laws and union requirements if there's a baseline for like what you can take out of wages. Right now, for some products, real wages are effectively reduced if they are paying to access their wages with these sorts of products. And then last thing I'll just note, like you have payment systems sort of conversations more broadly, whether at the Fed or real-time payment networks, like what does it look like when we have a broader system that is just real-time payments as a standard? Like, are these sort of products even necessary at that point? Like, will this be resolved if we did have a real-time payments network more broadly?
Thanks for adding that. I do want to point out, because I think Leslie and I were having this conversation in our prep of, well, if it's timing delay, that seems like this could just be solved if people were paid daily. Like that seems like an opportunity for payroll providers or, you know, an HR service. I did bring this up with our chief people officer, Taria Gray, who immediately sent me an essay explaining the complications that are involved in payroll and in payroll processing, and the amount of effort and work it does take to pay someone even in biweekly cycles, all of the different laws that are associated with it, all of the different administrative costs, the amount of people it takes. Not saying that that's the, you know, the reason we shouldn't do it, but I do want to provide that nuance, because I had added in our report a section of like, well, we could just pay people more often. And she did make it a point that I should add a paragraph explaining that it is more complicated than that. So I think that's important to note as well. We're getting tons of comments and questions. Swati, go ahead.
Similar, like agree with everything both of you are saying. And I think just as a note, we're seeing more and more of employers subsidizing partially or fully for these services. So this also kind of goes back to, we see the world in two different buckets where employer integrated service providers, more and more employers are willing and interested in subsidizing partially or fully for these services and other benefits they're offering in tandem, versus the direct to consumer advanced products that don't have that relationship and the consumer eventually pays for the price, or somehow different products cover the cost there.
Great. I'm going to move on to our next topic, but for folks that are watching, we do see your questions and we do plan to address them. Please keep the comments coming, because I think they're, even if we can't speak to them, I think they're really interesting for the other folks on this call to hear about. So please continue those. So I'd like to move on to cost, because this is a topic where there seems to be a lot more alignment. Both proponents and critics have highlighted that earned wage access and direct-to-consumer products are a more affordable alternative to traditional liquidity products such as payday loans and overdraft. And these products do appear to be targeted at consumers with few liquidity options. So what is likely keeping pricing low? Is it competition? Is it regulatory scrutiny? Is it something else entirely? And additionally, as part of the cost debate, there has been quite a bit of discussion over the merits or risks of a subscription or set fee model versus a voluntary voluntary fee or tipping model. And of course, that's a whole other animal. So I'd like to start with my first question of what is keeping pricing low? So is it competition? Please hold up red. Is it the regulatory scrutiny? Please hold up green. Or is it something else entirely and you disagree with the premise of this question, yellow? That's what I was hoping for. Okay, who wants to start on this one? Why don't we start with Leslie?
Okay, well, so I answered competition is holding down the cost right now. And I think, you know, we're seeing so many new entrants to this space, especially in the employer-based space. I think that has kind of opened up new types of revenue models and driven down the cost to some extent, or at least giving companies that are interested in partnering with earned wage access providers a lot of options to sort through. And from what I've heard from some of the earned wage access companies now is that, you know, in the beginning, they had to pitch this idea to employers by saying, you know, you can offer this at no cost to you. Your employees will pay a fee if they want to use the service. But now that employers are recognizing how potentially useful this is and how much their employees may want this solution, they're increasingly willing to pay for at least some of it. So I think that's really helping. Just the maturity of the market is helping make it more of a benefit that's provided to employees rather than something that they're going to have to take on the full cost of. Now, I wouldn't say necessarily competition is helping in the direct-to-consumer space. That I'm a little bit more unclear of, but I definitely think it is for the employer-based.
Great. Why don't we go to Swati?
I really agree with you, Leslie, in terms of the competition is keeping the prices low. But I think if you were to like really step back and look at it holistically, I think the regulatory pressure and the regulatory partnership in the space is actually providing those benefits, right? Of asking the providers to really provide a beneficial product at a low cost structure. And that's pushing the service providers to creatively find new ways of aligning and providing these services. What I think you're highlighting from that perspective is the likely outcome, and we're seeing this in direct to consumer space already with Chime and others alike, is that both the EWA and D2C advanced providers are kind of coming at it as challenger products in their respective spaces. So the primary competition to me isn't among providers, but I think it's amongst the traditional service providers in those spaces. So from D2C perspective, I think that's really traditional financial banking services such as overdrafts, costlier credit card structures. And then from payroll providers perspective, as they've identified, processing payroll is a lot of work. So we are not going to expecting a more faster payroll processing period is not likely going to happen anytime soon. Hopefully technology can get us there, but I think this is a substitute in getting us over that hurdle in that space. So I think those are the two kind of mechanisms driving the pricing here.
Thanks, Swati. Nikita?
Yeah, so I held up, I think it was yellow, just because in many respects, I don't believe at least some of these products are actually that much cheaper than the alternative. If you sort of calculate out the likely APR on a product, particularly in the direct-to-consumer space, but even some of the employer integrated ones can have triple-digit APRs if one looks at APR in that way. Now, there's often pushback in the market, like APR isn't the appropriate metric for these types of products. But I think in trying to draw out comparisons, especially for consumers, and trying to figure out, is this better than me taking out a short-term loan? Is this better than overdraft? Then having some metric by which to compare those sort of substitute products is useful. And right now, APR is the best that we have. And so with that said, the costs are in some respects comparable. Especially if, as your data shows, there are consumers who are repeatedly using these products, so then APR is even more justified, or some different calculation. But that aside, this market has added different cost brackets or pricing brackets that I think are useful in the marketplace. That was once just dominated by 300, 400% APR. So it has added cheaper services, particularly in the employer integrated context. And I think, though, like Swati's saying, that I think it's also largely a regulatory pressure, in part because the pricing models are so different, whether it's subscription, tip-based, per transaction, per pay period. Like if you think about competition, like for competition to work, consumers need to be able to compare, and one can't compare costs with all of these different pricing models. And so I do think it's regulatory pressure, or at least oversight, as critics and regulators are trying to assess the market. At least they can say, hey, we're cheaper. And so long as they can say that, I think that benefit gives them some leeway. And it's also important to note that besides the sort of inability to compare pricing, in this particular market, like these consumers, often even in the payday context, those providers don't compete on price, often because these consumers they're not as price sensitive, whether their need is an immediate need for cash. Payday providers tend to compete on convenience, proximity to consumers, the speed at which and the amount of money they can take out. There's some study years ago that showed that once a regulator or state regulator lifts the usury cap in an area, all payday lenders in that market increase their prices to the cap. It's not that they decide to stay low and compete. And so pricing isn't usually a point on which consumers in this marketplace compete. So it's really regulation and other critics that keep the pricing low. And last point is that I'd also be curious if, as Leslie was saying, employer integration can also help keep the price low, because employers can play a really important role in sort of negotiating, subsidizing, or otherwise on behalf of workers in these sort of contexts.
Great. Any other thoughts on cost before we move on to some of the questions that have been coming in the chat? All right, great. Thank you again for bringing up all of those very fascinating points, particularly around pricing. And I think, Nikita, you bring up a really great point that we talked about before, which is that pricing models differ quite a bit, even within the employer-based products or the direct-to-consumer products, and it is difficult to compare. And that was something that we, when we were doing our research, also struggled with, is how do we compare pricing? So we settled on percentage of advance amount, cost as a percentage of advance amount. And for us, that was an interesting way, but also a way that we could compare across all companies. So thank you for bringing up that point. So I would like to address some of the questions that have come up. And this is an interesting one that came up when we were looking at timing delay issues, which is that if consumers are paid on a biweekly schedule, some have argued that biweekly schedule has helped with, say, budgeting. So I'm curious if any of you have any counter arguments to the idea that, well, if a consumer is paid more often or less often, or if they have access to their wages sooner, it might make it difficult for them to budget when larger expenses come along. And I'll open up the floor, so please go. Yeah, go ahead.
Yeah, I would just say, I mean, it could be a useful mechanism to help facilitate savings through, maybe having longer payroll cycles, but I would prefer facilitating savings in other ways. So, having more frequent and more regular kind of stable income coming in, making it easier to budget day to day, and then facilitating savings through other means, whether that's, automated savings, taking a portion of wages and automatically putting them into a different account or some other method. But I get a little uncomfortable with thinking about, kind of artificially making pay periods longer than they need to be, or gaps in when someone can receive an income as a savings mechanism.
Yeah, I think I agree, and I'm a little torn on this because it's super paternalistic to be like, we're going to regulate your pay period because we don't believe you'll manage your bills well. On the flip side, I do think there's something to at least think about in terms of like, if pay is everything, every other expense is periodic. Your mortgage, car note, that's monthly. Like, you have these periodic bills that if the default rates on those other expenses increase because you're being paid daily, and if you have some other consumption issues, then we should be concerned about that, and how to manage that. And so Leslie's points of maybe having some other savings mechanism could be useful, but really thinking about the appropriate pay cycle is worth it. I think there was a small study that I read that actually some consumers, like what the employees themselves want, as a general matter, I think it was like 1 week might have been I may be misquoting the study, but it was a periodic pay period that they still preferred as opposed to something like daily. And I think because it helps regulate their consumption, and that study or another one had also showed that consumption increases when you are paid. And so it is something to think about. But I do think that is a different question than whether or not this is an increase in cost because of accumulated expenses versus how do we get consumers to adjust their behavior based on regular access to their accumulated wages. Yeah.
Great, thanks, Nikita.
I had a thought with, I think we might be combining the timing delay and savings too tightly. where they could be the function of different problems and different issues, right? The consumption of the earned wage access product and timing delays can be solving for their immediate needs, whereas lack of savings, which is a national macro trend, could be a function of just higher cost of living and many other issues associated with that, right? And I think these are the tools we can enable consumer in making better decisions, but they are different problems in our opinion. At Even, we offer a savings product, and we offer the option of allocating a percent of your paycheck towards savings, and we are seeing more and more consumers adopting and leveraging those tools, and that is bringing more predictable use of finances into their lives. So combining different solutions together can improve financial health. That's our hypothesis, and we're testing that. But I think we might be combining too many problems into one thing, and the root causes might be different.
Great, thanks. So I'm going to try to squeeze in one or two more questions, and these are more targeted. So first, Leslie, we're getting quite a few questions about market sizing and, how much of this market is dominated by, say, direct to consumer versus employer based. I'm curious if you saw any data in that. And we did get a specific question about if there's any market data on percentage of the market that is making fees versus on the interchange model. So for those of you that maybe joined late, we've found that many of these providers make money in different ways. Some, it's the employer that bears the cost. Some it's directly the consumer. Sometimes it's a mix of both, and sometimes it's neither. Sometimes funds are delivered onto a debit card, and in which case, if it's a Visa or a MasterCard, the provider might make the money off of the interchange fee. So Leslie, in your study, are there any insights that you can provide that might disaggregate the market data?
Yeah, sure. I looked at taking a stab at a market sizing of the employer-based earned wage access market. And I can say, in terms of growth, we're seeing, 100% year-over-year growth, slightly slower between 2019 and 2020, just with the pandemic. Employers had a lot going on. There weren't as many signups of new employers in the first half of 2020, but then as soon as they got into a more steady state, growth occurred again. So I wouldn't be surprised between 2020 and 2021 to see another 100% growth in the market there, in terms of the number of accesses, and then several $billion accessed early through those providers. I don't have a good sense of the direct-to-consumer market in the same way, but we do see millions of consumers downloading these apps. And one question I have is, for any given consumer, do they have 5 of those apps? Are they loyal to one? I don't know how much kind of layering is going on there, or can we add all those up, or is that the same consumer we're seeing again and again?
Thanks, Leslie. I'm going to squeeze in one more question while we have 2 minutes. And Swati, I'd love if you could explain a little bit about, from your customer base, for your customers that are, say, gig economy workers, how does their pay cycle work? Are they accessing wages sooner rather than later? And then second, if you do have insight into a pay cycle, when in that pay cycle are you seeing that consumers are typically taking an advance? From what we saw in the data, and granted, we did not have access to pay cycle information, we weren't seeing any patterns of, say, a time of the month that we were seeing an uptick in usage. So I'm curious if you have any insight into that.
Our observations are the same as you with respect to the timing. It's really associated. Again, we've surveyed, and the survey responses has been to pay their bills. We've not closely looked at the alignment of the timing there. To kind of speak to your first question around gig workers, it's my understanding most gig workers get paid out on a daily or a weekly schedule. So it is, again, I've not experienced this product myself, but my understanding of Uber drivers or Lyft drivers is they can choose to have what they earned that day get paid out on that day. What we're seeing from customers is an interest from employers is an interest in competing with that option and providing employees that option so that that benefit can be one-to-one when the employee is choosing, when a consumer is choosing to work from place one to place two. So I think that's where it's truly coming from for some of our employers. But from from a consumer perspective, that those are options available to them in the market right now.
Great. Well, thank you all so much. I would like to wholeheartedly thank all of our speakers, all of the companies that collaborated with us on this project. If you haven't already, I highly recommend that you take a look at our report. It is definitely the labor of love, so please take a look at that. Also, we are interested in future work, so if you'd like to collaborate with us on a project, please connect with us. If you'd like to do a deep dive on the existing report and ask more questions about the study, we are happy to set up one-on-one meetings. So please reach out. My information is on our website. I'll also give a quick pitch for our Emerge conference, which will be June 8th through 10th, and then again on the 23rd. I'm leading a session on fintech and fintech policy and their interactions with financial institutions. So please be sure to check that out. Thank you again for coming, and we look forward to seeing you next time.